Welcome back to QAV America. Tony Kynaston. I think this is episode 4. We're recording this on the 6th of May, Australian time. Just did an Australian show where we were covering some news around value investing. And the big news in value investing this week, of course, Tony, is the announcement of the retirement of your personal savior, Warren Buffett, which
he is. It's not often yet. To be honest, it's not often that I've had anybody in life, anyone to look up to as far as Warren in life. They don't come along very often, I don't think, who've made such a big change on my life. So yes, I'm happy to call him my personal savior. And Charlie.
He's your personal savior and Charlie. You mean Charlie's also your personal savior, Charlie Munger.
Yes.
Yeah.
I need someone to look up to for grammar, but yes, Charlie and Warren are my personal saviors.
Well, we just talked about Berkshire Hathaway and Warren for about 20 minutes, so I'm going to cut to that, and we'll be back to talk about an American company in a minute. All right, I'm going to cut to that. Warren Buffett in the
big news.
Berkshire Hathaway, the 60th annual meeting of Berkshire Hathaway, he announced that he is retiring this year. His 60th and final performance. And to be honest, I mean, I watched most of his bit. Without Charlie, it's not it's not the same without Charlie, right? It's just I keep waiting for Warren to do his bit and they go, "What do you think, Charlie?" And Charlie having some bon mot at the end of it. Some punchline. There's no Charlie punchline.
No Charlie. No.
No. Is this the second year without Charlie or the first? I think it's the second, right?
It's
second annual meeting?
Second. Yeah, second.
Yeah.
And he wasn't there during COVID because he had to lock down.
That's right.
Yeah.
Look, it's and Warren's sounding his age too, like 94. He sounded pretty croaky. He's walking with a cane, but I watched, I don't know, maybe 2 hours of his thing, like still incredibly entertaining, articulate.
Oh, yeah.
Just terrific. Telling stories about how a Berkshire Hathaway lab invented the rear vision mirror for a racing car. They used to have 2 guys in a racing car, one to look behind them, and their guy was sick and couldn't make it, so they invented the rear vision mirror. He's like, so if you're wondering what Berkshire Hathaway companies are doing, just inventing things like rear vision mirrors for cars and stuff like that. There's some subsidiary of a subsidiary of a subsidiary that was involved in it, but yeah.
My favourite anecdote, I've only listened for the first half of it, and it's available on both podcast and YouTube if anyone wants to do yourself a favour and sit down to 4.5 hours of it. But my favourite anecdote was when they were talking about the cash pile that Warren had built up, and someone asked him from the audience whether there weren't enough fat pitches to swing at. And he said, well, yeah, it's a bit like life. A 10-year-old's going to have a lower chance of dying tomorrow than a 94-year-old. So you don't always get the same odds every time the market, wherever you are in the market cycle. And he said, as to longevity, I also point out that females live longer than males. So I tried to convince Charlie they'd have a sex change.
It's a great line. It was a great line, yeah. Some kid got up and asked him, said that he'd always advocated moving slowly, and were there times when moving quickly had benefited them? Have you heard that one?
Yeah, but go ahead. Tell her it's great.
Well, no, he just says, there have been times when they moved quickly, and he talked about one guy, I think it was the same guy that sold him the company that ended up building the rear vision mirror, but he found a guy that his business partner had died, and this guy didn't want to do business with the guy's widow, so ended up calling Warren and saying, hey, you want to buy my company? And they moved quickly and did a deal, like, in 10 minutes with a handshake. But he said, basically they move slowly to build up the cash, so when they need to move quickly, they can. That's basically, it's not like he always moves slowly. you move slowly until you see the reason to move quickly, and then you move quickly. But it was like a 20-minute answer to the question, but it was a long, meandering, anecdote-filled answer. But it was great, and I'm going to miss that.
Oh, yeah. Yeah.
He is the end of an era for many reasons, but one of them is just that country bumpkin, down home, soft, just gentle, nice man of integrity, old school, who does business with his head held high and, treats people with respect, expects to be treated with respect. He said something about you have to be willing to hang up within 10 seconds, but also like close a deal within 10 seconds as well. He was talking about how most of the people he just says no to very quickly.
Yeah,
but then there are the times when he says
30-minute
yes
deal
quickly.
he's spoken about before, where he says, I asked 5 questions, and if they can answer those, it's a deal.
Right.
So, I mean, he won't divulge what the 5 questions are. People have tried to work them out, but he has five questions, and which is amazing. And he acted very quickly during the GFC to bail out some of the American banks and to be the lender of last resort, and to do 2 very favourable deals for Berkshire Hathaway to recapitalise some of the banks at tremendous interest rates back to Berkshire, and convertible note deals. So, yep, he's smart.
And Greg had a good follow-up to that too, where he said you don't underestimate the amount of work that's happening behind the scenes when we're moving slowly, so we can move quickly when the right deal comes. They said there's can't remember the number, but there's a handful of businesses that they understand really well, and they're ready to move on really quickly when the right price, right opportunity comes across their table. So they've done their due diligence.
Yeah, sounds like a buy list, doesn't it?
Yeah, they have a buy list. Yeah, exactly. They're just waiting for the price to be ready, and waiting for times to be tough enough that people come to them. But as always, people asked him about, they asked about AI. I think it was Ajit. They asked about AI. Warren said he would take one Ajit over 100 AIs any day or something like that. But
for the next
Ajit
10
also
years,
said AI is going to have a huge impact on the Geico business, the insurance business. But they also talked about the prospects of the US, a lot of doom and gloom, obviously, about the US markets and the future of the US. And Warren, as always, was very sort of optimistic about the future of the US, but then also did disclose that they've bought a lot of foreign currencies. So I don't think he's as optimistic about the future of the US dollar, but yeah.
Well, he made a couple of comments, and he tries not to be too political, but know, he said it doesn't end well if one country beats their chest and says, hey, look at us, we're really good, and the rest of you can go away. He said that world trade helps all countries, which I think is I think is true. Someone in writing about, I think it was Warren, but he does like to say never bet against the US, and he pointed out at some stage that the stock market in the US had risen from $66 to $11,497. This is a few years ago, I guess, despite 2 world wars, a depression, and a dozen recessions, all shocks and flu epidemics. So, he's always pointed out the long-term game of backing the US, and the fact that it's going to, probably still going to be around for a while. So I thought that.
Yeah, but
even though he's investing heavily in Japan and overseas for sure.
It's cherry picking the era, though. I mean, he's talking about the success of the US during the century when the US was basically the unipower of the world. I mean, there was no other competing forces in that 100-year period. From World War I, mostly after World War II, the US didn't have any competition economically or militarily, really. It had a very empty runway. And it's not that case. It's not the case anymore. It's not going to be the case for the rest of this century.
We'll see. It's they've certainly done well so far the first 25 years of this century. Stock market's up dramatically. and they're facing competition. But yeah, maybe it'll be tougher. I mean, I think they did face competition in the first bit of the US in the 20th century, the end of the British Empire, and some parts of Europe anyway. So yeah, they had a lot of tailwinds for sure. All I'm doing is commenting on what Buffett's saying. They may have difficulty going forward. They may have had headwinds last century. They still have headwinds. I think they'll do okay.
Well, we'll see. Let me move on. Do you want to talk about Warren more? Do you have more Warren comments?
I do. I've got some quotes.
Okay.
Yeah, so let me just go. Yeah, so just on that, one of his quotes from the annual meeting was that he accepts that the American process has not always been pretty and is infested with scoundrels and promoters. So I think that's to your, comments as well about US exceptionalism. But despite all that, he still says don't bet against America. There was a talk about the investment with Apple and Bank of America. So the quote is, Berkshire has been selling down its enormous stake in Apple and Bank of America as the proceeds have accumulated into an enormous pile of cash, 536 billion Australian dollars. The initial investment was one of the greatest trades of all time as the firm, which is Berkshire Hathaway, accumulated 900 million shares in the iPhone maker. Buffett quipped that Apple chief executive Tim Cook made more money for Berkshire Hathaway than he ever did. The investment grew from about 35 billion to 173 billion US in about 6 years. However, last year Berkshire began selling and reduced its Apple stake by 2/3. There was some speculation at the time that the sales were part of a succession plan, given that Buffett's 94 years old. Buffett did indeed confirm that he was stepping down, but he said he had no intention of making Abel, who apparently didn't know about the succession plan prior to the announcement in advance, look good by handing him a wad of cash.
Yeah.
The big liquidation of Apple stock proved justified as trade wars and supply chain concerns have since sent the stock down as much as 20%. So I think he said something like, when someone asked him about the pile of cash, was it set up to make Greg look good? He said, no, I want to look good. Article today quoting some of the Australian fund managers on Warren Buffett. And I should say, in addition to the comments I'm about to read out, if you are listening to this and you haven't read the collective shareholder letters of Berkshire Hathaway, and you haven't read either The Making of an American Capitalist or The Snowball, just drop what you're doing and go and buy both of those and read them, because they are the best course you'll do in investing, full stop.
Yeah.
So John Abernethy, which is, he's the chairman of Climb Investment Management. And I declare I'm a director of CIW now, and have been a long-time fan of John. But he said, Warren Buffett has an overwhelming supply of common sense. That gives him the capacity to invest both logically and methodically. Of course, common sense does not mean that he always gets things right, but it does allow him to make consistently good decisions and to quickly identify and rectify wrong ones. Both of these attributes make him a great investor and, importantly, from a human perspective, a great mentor to the investment world through his published thoughts and letters. Andrew Mitchell from Ophir Asset Management said, one of my favourite Warren aphorisms is, I don't look to jump over 7-foot bars, I look around for 1-foot bars that I can step over. Whenever a day like Liberation Day tariffs come along, I remind myself of Buffett's never-wavering view of America and capitalism and the positive sum game that investing is. That was a quote about the Dow going from 66 to 11,000. Chris Prunty of QVG Capital says, I was 17 when I bought the Warren Buffett Way at Dinnick's and Tuggeranong, Canberra. I read it immediately and thought this is what I want to do. That was my first real introduction to the world of stock picking. What I've learnt from him the most is rationality and discipline. Even when answering financial questions, he's deeply analytical, always going back to the numbers. It's incredibly difficult to maintain outsized returns when managing vast sums of money, yet no one handles more than Warren Buffett in terms of money, and still he's continued to generate credible, sustainable returns. That combination of scale and success is almost unmatched. Finally, his willingness to teach and share what he's learnt is another remarkable quality. He's been generous with his insights, helping others understand the principles behind his success. And lastly, Jeff Wilson from Wilson Asset Management. He says, Charlie and Warren's influence wasn't just about stock picking, it was about instilling common sense and sound principles for both investing and life in general. Buffett and Munger made complex financial concepts accessible and practical, teaching not only about investing, but also about the skills and mindsets needed for success. They shared life lessons and transcended the world of finance. Their ability to communicate the benefits of long-term investing, discipline, patience, and rational decision-making has left an indelible mark. For decades, they showed us what it takes to succeed in investing, how to think independently, and how to make decisions based on thoughtful analysis rather than emotion. So I echo all of those sentiments, and if I ran the school system in Australia, I'd make the life and times of Warren and Charlie part of the curriculum for all people going through grade 12 before they enter the workforce.
Roger Lowenstein, who wrote Buffett, The Making of an American Capitalist, wrote an article in the New York Times today, "The likes of Warren Buffett we will never see again." And I just wanted to read a couple of paragraphs from that. He says, Berkshire stock on that day in May that Warren took over the company, it was 1963, closed at $18 a share. When he delivered the news of his retirement, it was above $809,000, almost 45,000 times as high. Over the same span, the Dow Jones Industrial Average is up just under 45 times. How much did you sell your Berkshire shares for, Tony?
No, don't keep reminding me. It's
Wasn't that
a lot
big a
less than what
difference,
they
wasn't
are
it?
now. I think it was, going from memory, it was in the 300s from memory, thousands.
Yeah, that was years
And
ago.
I did it.
So that's only.
It was. And
yeah, that's
I did it because I actually was concerned what happens to Berkshire Hathaway when Warren and Charlie go. And it'll be
the
interesting
share
to
price
see.
is down.
Is it? Okay, I haven't checked.
Yeah, I heard it was down like 6% or something after he delivered the news. Anyway, Lowenstein goes on, Mr. Buffett has long stood out on Wall Street because he eschewed its frequent chicanery, self-dealing and greed, and the double talk that went with it. He revered the institutions of capitalism. Most especially, he treated the executive's duty to shareholders as a sacred trust. Lest he be accused of violating that trust, he capped his annual salary at $100,000. He never took a stock option, the unholy tool by which chief executives expropriate a piece of the business from the shareholders for whom they are fiduciaries. In corporate America, that made him all but unique.
Correct. 100%. And largely didn't sell shares along the way. He's been giving them to charity. He's part of the wealth pack, the giving back pack. Yeah.
Yeah, and lived relatively simply, right? Same house, same car, more or less. He said he had a few divorces along the way and moved stuff
We have
around,
one.
but
Yeah.
right.
And he
Lived
you know,
simply.
he lived simply. I think that may have changed over the years. I think he was a good marketer when it came to that story.
Right.
I've been to his house in Omaha. It's certainly, a classic middle class suburban house in America. But I think he probably has lived out of hotels for a long time.
Right.
And at one stage, there was a corporate aircraft for Berkshire Hathaway execs to fly around in. So, yeah, he's done okay on the lifestyle front. I'm not going to begrudge him that.
But he didn't live some sort of exorbitant, gaudy sort of lifestyle. Like he kept it relatively simple.
Correct. And, I turned on the TV again this morning and there was some clip for some dude from the US, sitting in a Maserati or driving a Ferrari, singing his song and sitting on a yacht and, drinking champagne. And I'm just thinking that's not a good image in my opinion. Warren's image is much better.
All right. Anything more you want to say about Warren before we move on?
No, and we're kind of sounding like he's passed on. He hasn't. He's probably still going to exert an influence on Berkshire Hathaway. But yeah, next year's AGM will be interesting. Warren leaves, I think, in December. So it'll be 6 months under Greg and Ajit and Todd and Ted and everybody else. I suspect, Warren's thought long and hard about succession and how to structure Berkshire, so it's hard to take over and break up, and to give Greg the right kind of training to trust Ajit and to trust the investment team, etc. So, it'll be interesting to see what happens.
You think 30,000 people will turn up to the annual meeting once Warren's not there?
I have thought about this. It's more than 30. When I was there, it's like there's they use one of the arenas which holds 40,000 people. But if you don't camp out early in the early hours of the morning, I think I got there about 4 a.m. You don't get a seat. You're forced to cross the road into one of the hotel ballrooms to see it live on TV. So it's more like probably double that turn up to Omaha to go to the AGM. But anyway, I think if Warren turns up as a shareholder, I think yes. I'd be surprised if I was Greg Abel. I'd be inviting him up on stage to take some questions. I don't know if Warren will do that, but if the sort of people think he will, they'll turn up. I think some people will turn up just to see how Greg performs and what's happened with Berkshire Hathaway, to get some kind of comfort that there's essentially no change in the strategy. But it'll be interesting to see.
All right, let's move on. Before we get into your deep dive for the week, Tony, I just want to touch on the performance of our US dummy portfolio. As I mentioned last week, I started this in September 2023, so it's been going for 18 months now. Current performance over that time is 56.51%. That's the return on it in that 18-month period, versus the S&P 500, which is up about 27% over the same time frame. So if I look at the last year, we're up about 38% over the last 12 months versus the S&P up about 10%. And if I look at year to date, it has not been as glamorous. We're down 16.5% year to date versus the S&P down 4%. And I'm sitting on about $4,000 cash in the portfolio that I haven't been able to invest yet. I did a buy list last week. When I went to buy stuff, everything was having a down day. I couldn't find much. I think I found one thing we talked about last week. I did another buy list on the weekend with the intention of trying to find time to spend that money yesterday. Had a whole bunch of things blow up in my face yesterday, so I didn't get to do it. But I'm going to try which is about, I don't know, 25% of our portfolio that's sitting in cash, which isn't ideal. So I'm trying to get rid of that as soon as possible this week. All right. But it's doing well. I mean, basically, as we said, I think last time, when we started thinking about how we applied your framework to the US market, we weren't really sure how it would go. We have a different data provider over there, Stockopedia, than we were using here, which didn't have all of the data that we normally use, and some of it was a little bit different, and I had to modify the checklist process. But, up 58% in that 18-month period is good. So it's working well.
It is. And no Mag 7 stocks to be seen in the portfolio.
No, they're all boring ass shipping and local financial services companies,
Banks.
That's, boring companies that are just generating a lot of cash that we can buy cheaply.
Yes, exactly.
A great company at fair value.
Well, yeah, I think the values are even better than fair. Like, buying a bank at 3 times operating cash flow is pretty good. Good price.
Better than fair.
Better than fair. Yeah.
Doing that.
Mention stocks for beginners.
So, yes.
We should let our listeners know that Phil Muscatello, friend of our show, has interviewed me last week, and we'll put out a US Stocks for Beginners show where we talk about my background and how QAV works. So anyone who's interested in knowing more about QAV, look out for Stocks for Beginners in your podcast feeds.
And thank you, Phil, for having Tony on yet again.
Yeah, thanks, Phil. Good to see Phil. I haven't seen him for a while. He's living up in the North Coast now. telling me about the acreage he has looking over the river. Sounds wonderful.
Keep telling him we've got to catch up for lunch, but he keeps blowing me off. I'm starting to take it personally. Now, I didn't have time to do a prep for a deep dive on an American company today, Tony, but you took that for me, which I appreciate. So just to explain to people before you get into doing your deep dive or your pulled pork, as we call it, the reason we do these is for people that are new to QAV, just to explain in a little bit of detail in each episode by taking a case example, one company that we can look at in a little bit more detail, how we value the different fundamental metrics and why we value them. So we don't often, when we're doing our analysis, get too deep into the story of any business or the history. We tend to just look at the numbers, but we find it is helpful if you take one particular example and you break it apart. And it's interesting for me anyway to learn a little bit more about some of the businesses that are on our buy list each week, but also gives Tony an opportunity to talk about the numbers and how we scored it and why it's on the buy list, I guess.
Yeah, no, I agree. I think it's always nice to know a bit about what we're buying, but we are focusing on the numbers and then painting a bit of a picture about the company behind it. It's probably more relevant to my Australian investing experience, but you do sort of learn little things along the way too, and that can come up during a pulled pork. One of the stages before I buy something is to do a quick market scan of any news, something you have to take into account in your decision to buy this stock versus something else on the buy list, not just the score. So yeah, I think it's worthwhile doing a pulled pork, but it also does show how you can have something going on in the market, like how is the tariffs going to affect the Canadian economy, which is pretty uncertain. And a business operating in that market, but still scoring well on the numbers, which gives me some confidence for it.
All right, let's get into it.
I'm going to do a deep dive on a Canadian company, Cam.
Okay.
Canadian Imperial Bank of Commerce, CIBC as it's known. And the code is CM. And one of the reasons why I picked this is because my wife used to work for CIBC when we lived in Toronto up until 6 odd years ago. So my experience is a little bit out of date, but it was nice to see a company I knew firsthand on the buy list, even though we don't live in North America. And we don't have any shares in CIBC anymore. Jenny had some when she was working there, but they've been sold over the years. And the other point, I guess, to use as a preface is that this is a dual listed company. So it is listed on the New York Stock Exchange. CM, as I said, is the code, but it's also dual listed in the Toronto Stock Exchange as well. I'll be using US dollars in this analysis and the US listing as the basis for the commentary. So CIBC, Canadian bank, what does it do? Well, it's primarily a retail bank, is probably the first thing to say. They obviously have expanded a lot outside of just providing mortgages to customers. They also own credit cards and loans for to buy cars and other personal needs. And like all the Canadian banks now, they have gotten into wealth management in a big way and facilitate share trading and things like that. But they're basically a retail bank. So they're not like your Goldman Sachs or your Deutsche Bank out there doing big mergers and acquisitions deals. They do a bit of that, but primarily they're a retail bank. Why is that important, Cam? Because during the GFC, the 4 big banks in Australia and the 5 big banks in Canada came through intact and largely unscathed, which was more than almost any other bank in the world. And you can remember the crisis that the GFC, that kind of kicked off the GFC, was a lot of problems with a couple of banks in the UK and with the banks on Wall Street. So retail banking, even though it was seen as a fairly stodgy business sector, sailed through the GFC from a risk point of view. And Canada and Australia were the only 2 sectors that did that. CIBC is headquartered in Bay Street, Toronto, which is the Wall Street of Canada. And as an aside, Bay Street was often shut down as I was going to pick Jenny up after work. And it was full of film trucks, setting up to use the Canadian financial district as a backdrop for series like Suits and movies. Suicide Squad was filmed up there. And as of today, there may be 100% tariff on overseas produced movies and TV. So we're all waiting to see what happens with that announcement. What else can I say about CIBC from my own personal experience? I always found their branches in Toronto comforting. They were large and spacious and had chairs for people to sit in and bowls full of lollies to munch on. And I always thought that was an interesting strategy, being an old retailer myself. Then I found out it was driven by the desire to protect old people during the Canadian winter. So CIBC was trying to position their branches as a bit of a haven in a snowstorm, literally, and look after its customers when the weather wasn't great. Other differences, the Canadian banking system were a big user of checks to pay for things. They didn't have, like we have in Australia, a pay from account to account between the banks in Canada. So, if you had to pay a bill, you wrote a check and put it in an envelope and sent it off to the gas company. And you didn't go online and do a pay anyone transfer like we have in Australia. Now that may have changed since I've left Canada, but it was certainly an idiosyncratic part about the Canadian banking system. The other, I guess, thing to highlight was the Canadian pension system is a bit different to Australia and to the US, in that I think last count was about 40% of Canadian pension funds are still what's called defined benefit plans. We have almost none of those left in Australia. We have defined contribution plans. So basically, a defined benefit plan gives a retiree a certain multiple of their last salary or the average of their last 3 years as an ongoing payment, almost like a pension payment. And the pension plan bears the risk on being able to do that, as opposed to defined contribution plans, which say we all pay in a certain amount, and then the end user faces the risk if the share market goes down or if the world goes into recession. Different ways of managing it, but I guess if you're an actuary, head over to Canada, because that's where the action is. If you're an actuary, not that they see themselves as being action oriented, but that's where they should head to. But it has meant that in Canada there are some large companies which have benefited from that environment. Investors around the world may have heard of things like the Ontario Teachers Pension Fund, OMERS, the Municipal Employees Retirement System of Ontario, and also big companies like Brookfield Asset Management, which are large companies operating these kinds of pension plans, and they've pooled the assets and are now investing in a lot of commercial property around the world, a lot of unlisted assets, infrastructure, for example, but also in large companies. So that's something which has sprung up from Canada that people may have experienced. What can I say? What does Canadian Imperial Bank of Commerce say about themselves? They have over 14 million personal banking, business, public sector, and institutional clients in North America and around the world. The company has 4 strategic business units: Canadian Personal and Business Banking, Canadian Commercial Banking and Wealth Management, US Commercial Banking and Wealth Management, and Capital Markets and Direct Financial Services. CIBC is part of the Big Five in Canada, like the Big Four in Australia, like CBA, ANZ, Westpac, and National Australia Bank. There are 5 companies like that in Canada. Together, they make up 84% of the market share in Canada for banking. However, CIBC is at the smaller end of the Big Five, depending on how you measure market share, by revenue or by other ways. It's either 4 or 5. In terms of its market cap size, it's about the same size as ANZ in Australia, which probably means something to Australian listeners. RBC is the Royal Bank of Canada, is the largest bank. And interestingly enough, RBC has 26% of its revenue coming out of the US now. So in the last sort of 10 to 15 years, the Canadian banks have diversified into the US. RBC led the charge. So the tariff and tariff risks are a hot one for a bank like RBC, and also for CIBC. but it's a smaller issue for them, given that they're a smaller bank and haven't been as successful at getting into the US as RBC. But I've got a couple of quotes here about the issue. This one comes actually from an RBC capital markets analyst who says, Canadian bank stocks could see another 9 to 16% downside if President Trump's tariff threats materialise and Canada's economy weakens. Our observations indicate that banks with the largest market exposures to economic uncertainties tend to be penalised by the market. Median prices of large Canadian bank stocks have declined approximately 7% since Trump's February 1 tariff order on imports from Canada, but says valuations do not reflect the worst-case scenario. Brokerage says that CM and BNS, two banks, with highline exposure to Ontario and Mexico, have been hit the hardest, while BNO and NA with lower risk premiums have held up better. So again, they're other banks in Canada. Last month, top Canadian banks said that they would wait for clarity on US government tariffs before increasing rainy day reserves and taking a cautious stance as trade risks cloud the economic outlook. So that's a comment on the fact that the trade issues and tariffs on Canada and Mexico will affect these banks. However, if you look at the sentiment chart that we have for CN, it's actually been reasonably bullish. I'll just call it up. If I look at CN in the New York Stock Exchange, just bear with me while I call it up. The graph says that, just loading. Here we go. Still loading. Oh, look, it's having problems loading at the moment, but from looking at it before, it's the trend is upwards in the share price for CIBC. It's above its buy line and above its sell line, so it's certainly getting strong sentiment, even though there's a lot going on in the US, or in this market, in banking market in Toronto. The other
I've
thing
got
which
it
has happened,
open in front of me,
please.
Tony. It's trading at nearly an all-time high, which is interesting. Looking at its 10-year chart. It's currently trading at about $63.78. All-time high was only like late last year, and it was slightly north of that, maybe $64, $65. But it's looking very, very strong.
Yeah, which is surprising given everything that's going on with tariffs and how it would affect the Canadian economy and banks operating in the US as well. The other interesting thing is that they've announced that their CEO is going to transition to retirement in October and be replaced by a chap called Harry Colhan, currently the head of the Canadian Bank's Capital Markets Division. So he will serve as Chief Operating Officer as of April 1 this year and take over as CEO in November 1. Interesting thing about him is that he started off he's come up through the ranks in CIBC. So I think it's always good to see succession from within. You've certainly got someone who understands the business inside and out. He says, I understand the risk quite well. This is about the trade issues between the US and Canada. I understand risk quite well. It's one of my strengths. We're not worried, Colin said in an interview with Reuters, which I think is a bit of hubris, really, but to say you're not worried. But anyway, hopefully he's a bit more sanguine when he reviews the business and takes over the business. He says, we can control the controls, and we think we're good at that. We went through COVID. We've been through other ups and downs. Reuters reports that Colin joined CIBC in Vancouver as an intern, participating in its graduate programs. He held senior banking roles in Europe and Asia before rejoining CIBC in 2008, so at the end of the GFC. He became the head of the capital markets unit in 2015. What else can I say? An RBC Capital Markets analyst said that Colin brings solid experience in capital markets that will be beneficial to the bank, even though his personal and commercial banking experience is relatively limited. So I can go on, but we've covered most of the issues that they talk about there. So let me talk about their results. And this is, I think, what was driving the share price recently. And I want to also highlight that we use the Q1 results delivered on February 27 for our QAV analysis, which I'll go through in a minute. But the next results are going to be announced on May 29. And given all that's happening, all we've just spoke about with the tariffs that have been imposed on Canada and Mexico, the results may change and guidance may change. So we may not see a huge change in numbers in the 3 months since the tariffs were announced, but certainly guidance may change. But the last set of results were very good. Revenue was up year on year 17%. Earnings per share was up 22%. Both solid results. NIM, so net interest margin, is something banking analysts will focus on, was 1.5%, and that's broadly in line with what we see with Australian banks. Return on equity was 13.3%. Again, we don't focus on return on equity in our calculation, but that's a good number for a bank. Common equity tier 1 ratio was 13.3%. So we've spoken about the tier 1 ratio when we've done pulled porks on Australian banks before. But basically, it's the amount of capital, which doesn't have to be cash, but it can be things that they can liquidate in the short term, which is a buffer for any sort of run on a bank if there's a downturn in the economy. And regulators will set a tier 1 capital ratio and tier 2 and tier 3, scaled to be how quick you can liquidate the assets, which are available to pay out customers who want to redeem their savings from the bank. And the higher that number, generally seen as being the stronger the bank. And 13.3 is a pretty strong number for tier 1 ratio. So not only is the bank doing well year on year, but it's also pretty robust from a regulatory point of view. So that's good. As I said, these results occurred prior to Liberation Day, so the next results will be an important update. But to use to borrow a Warren aphorism, we're buying straw hats in winter with this bank. It's cheap based on its current metrics, and its sentiment's still strong, so it hasn't been sold off because of Liberation Day. So we'll see what happens in the future, but at the moment it's worth looking at. QAV numbers to analyse the stocks. The stock price I used was $63.72. That's less than our intrinsic value number 1 calculation of $77.39. But above our intrinsic value number 2 calculation of $37. And people can go to the website and have a look at what those calculations are. But basically, it's a deep value, intrinsic value calculation, and one which is more in line with how analysts will put a price on this company. As I said, sentiment is an uptrend. Oh, here we go. I've got in my notes here, the buy price is currently $55.23, and the stock price is $63.72. So it's above the buy price. ADT, average daily trade for this company, is $70 million. So it's very liquid and would suit most personal investors. I think probably all personal investors. Price to operating cash flow is just above 3 times. So it's a very cheap payback if you invest in this company based on the operating cash it's throwing off. Stockopedia ranked this company as 69 out of 100, which is a bit on the low side. We give it a score on our checklist if the quality is above 60, a ranking of 60 in Stockopedia. I think the reason for it is even though CIBC gets an F score of 6 out of 9, which is really good, and an F score is a way of valuing the quality of the financials of companies. There's no Z score, which is another way of looking at the bankruptcy risk for companies. And so we can't score it for that. And I think I've seen this before, that quality ranking styles or systems, like in Stock Doctor in Australia, often have problems adapting themselves for banking companies and financial services companies, because they basically come out of scoring industrial companies, and banks have a different kind of play of the metrics than industrial companies. So I think that's why the The quality ranking's a bit lower in Stockopedia. There's no Z score. But overall, Stockopedia rank CIBC as 96 out of 100, which is quite high. So that's good. We score it for that. PE ratio is just over 10 times, and it's in the range for the last 3 years. So we don't score it for being above or below that range. Can't score it on PE. Earnings per share growth is forecast at 11%. But if I put 11% over the PE score, I'm getting a price to earnings growth of 1.06. And we look for a threshold of 1.5 before we give it a score in QAV. So no score for that. Yield is high, but not higher than the average mortgage rate. So yield is 4.17%, so we don't score it for that. Book value per share is $59, so I can't score it for book value, so we can't buy it for less than book. But we can buy it for less than book plus 30, which is $77.48. So that's good that we can buy it for just above its assets. This company's been around for a long time, and it's a large bank, so we don't have an owner-founder, so I can't score it for that. Book value is increasing, so we like to see consistently increasing equity over the last 3 years, so we score it for that. So overall, the quality score is 64%, and when we plug it into the checklist, we get a QAV score of 0.21, which is quite good for a bank, so it's good. I think I've outlined the risks as we've gone through the analysis, but just to say again, to highlight, the next earnings call will be an interesting one, which comes up in a week or so. And so I highlight this as something to put on the buy list for customers in the US or for listeners in the US. They might want to wait until the earnings call comes out to see how the numbers pan out after that. But one to watch.
Thank you, Tony. Have a great week. We'll be back next time. If anyone has any questions, don't forget to go to QAVamerica.com and find my email address on there. Shoot me an email if you've got questions for the show for next week.
Yeah, please. We need a US Trent to ask us lots of questions. One of our listeners in Australia.
Glad you explained that.
Always good.